I'd like to welcome everyone, and we acknowledge the traditional custodians of the land on which we meet today. We're having a lunchtime seminar at the Centre for Commercial Law and Regulatory Studies, or CLARS, and our speaker today is Dr. Tim Bowley, who is an adjunct associate professor of law at Monash Law School. Tim is with us in person in Melbourne today. He's giving a course at the moment, or teaching a unit on international M&A, and he's later this year going to be teaching a unit on ESG and society and corporations. So we're very fortunate to have Tim here today. And Tim's going to talk to us today about something that was a very big issue last year in Australia, that after 2 years of lots of hard work, to have the most recent iteration, the 5th edition of the ASX Corporate Governance Principles and Recommendations brought into Australia, suddenly there was a cataclysmic failure. And I think, that cataclysmic failure is not just a local phenomenon. I think it, reflects greater geopolitical trends internationally. And I'm going to pass over to Tim now to give us more detail about what happened and what it means for corporate law in Australia and the world.
Yeah, thanks, Jennifer. So this is working. So yeah, I want to talk about the aborted attempt to update the governance principles through the release of a 5th edition. When it sort of crashed and burned, much of the contemporaneous commentary about the episode perceived it as an example of pushback against, for want of better words, wokeism and stakeholderism in corporate governance. Now, whilst that perspective might accurately describe some aspects of the episode, it misses some other significant insights and implications. And I want to talk about some of those broader insights and implications in this session. Specifically, I'd argue that the events surrounding the demise of the 5th edition are significant for how they revealed notable disagreement among key stakeholder groups about what constitutes good corporate governance for Australian public companies. The episode has precipitated significant change in the institutional framework that underpins the development of Australian corporate governance norms. It has prompted a potentially significant shift in the objectives of the corporate governance principles. And finally, it's shone a bright light on the political economy that underpins Australian corporate governance. So, to provide some context for this discussion, I want to start by spending a few moments examining the genesis, the brief existence, and then ultimate demise of the 5th edition. Sorry. Just bear with me one moment. I've lost control.
Oh, the keyboard.
Yeah.
Me every day.
Okay. So I'd like to, and by the way, I know we've got some people online as well as the people here in the room. I'm more than happy to take questions as I go along, and it's just going to be subject to our technical abilities to see hands going up online.
You can monitor that.
Okay, so tomorrow we'll monitor it. So if you have a question, feel free to ask at the point at which it comes up rather than necessarily waiting till the end. So the timeline. Jennifer mentioned 2 years. It actually was an even longer project than that. So Tim Bednall, who's a Mallison's partner, who was the Law Council's representative on the ASX Corporate Governance Council, has publicly disclosed that the council made a decision in 2022 to start preparing the 5th edition, and they formed a drafting committee of 14 members back then. And I think that might just give you a sense of what was to come, the fact that the drafting committee consisted of 14 members. So that started in 2022. February 2024, the council released a consultation draft of the 5th edition. Consultation ran and then closed in May 2024. And then there was radio silence pretty much from the Governance Council until February 2025, when they announced that it wouldn't be proceeding. And between May 2024 and February 2025, there was a fundamental shift in sentiment regarding the fifth edition and the governance principles more generally. And I'll go into a little bit of detail in relation to that in a moment. So in the aftermath of the failure of the fifth edition, the ASX convened an independent review panel. So that was in June 25 to basically examine what had happened and think about what would be a better way forward. So then towards the end of 2025, the review panel handed down its recommendations, which I'll talk about later. Among other things, the ASX, one of the recommendations they accepted was to disband the Governance Council, and the ASX will now take control over the governance principles themselves. They will do so with the help of an advisory group, and the advisory group they announced then, would be chaired by Philip Lowe, former Governor of the Reserve Bank. And they made the point that the members of this advisory group would be joining and participating in their personal capacity and not in a representative capacity. We'll talk about that in a bit more detail later. And then in January this year, they announced the full membership of the council.
Who chose them?
The ASX put out an invitation for applications.
Right.
And then the ASX, presumably in consultation with Philip Lowe, chose them. And I'll come in a minute to show you the identity of those people. It's an interesting group. So I said I just wanted to talk about what happened in that gap between submissions, consultation closing in May 24 and the ultimate demise of the fifth edition in January 25. So there was a major shift in sentiment, and it's quite interesting to look at the submissions that came in during consultation. And the submissions, even from organisations that you might expect to be critical, were all reasonably positive and importantly, all sought to engage with the fifth edition. But a number of those organisations changed their tune towards the end of 2024. The AICD was a notable one. If you look at their submission, said, we welcome the update, and then by the end of the year, they were saying this fifth edition, it's no longer fit for purpose. And in fact, they were calling for a fundamental review of the Governance Council. So you can really track a change in sentiment. And notably, towards the end of 2024, you had senior directors coming out and openly criticising both the fifth edition, the principles generally, and the Governance Council, and they were joined by some serious investors. So people felt, I guess, that they were no longer needed to be restrained in their criticism. Now, of course, a major thing that did happen towards the end of 2024 was the US election, with Trump coming in and rolling back DEI initiatives, among other things. That, I would suggest, was perhaps more a straw that broke the camel's back, or it was perhaps an event that made people feel that it was permissible for them to engage in much more open criticism. So that division that emerged, you can then trace to the Corporate Governance Council itself. And it was reported in the press that when they had to decide what to do with the fifth edition in January, around the table, the two representative bodies of the super funds, ACSI and ASFA, were strongly in favour of the fifth edition. The AICD, the Business Council, Property Council, the Investor Relations Association, and the ASX itself voted no. And then the G100, which is an organisation of chief financial officers, the AICD and the Financial Services Council, said they did not like it, but were in favour of a different approach. So you have an interesting split there, certainly between capital and corporates. You might be a little more specific and say it's between the big superannuation funds and corporates, but there was a pretty clear line of demarcation there amongst the Governance Council.
Tim, can I just ask, one of the things that I found weird about all of this was I felt as if it was really only one or two provisions that everybody was up in arms over, sort of diversity on boards and whether or not to bring into play people's, sexual background and race as well as gender.
Yeah.
And I just couldn't understand how suddenly the entire fifth edition seemed to be at play when to me, it was just really those provisions. So how did that happen?
Yeah, look, I think, and you're right, it was a drafting note. There was a drafting note in one of the consultation documents around disclosure of diversity characteristics.
Yeah.
And that was the sort of the, what's the word, that was the lightning rod.
Yeah.
I think I'd say that was perhaps in the nature of a fig leaf, that was people who had actually deep reservations about the principles as a project hit upon that as a convenient way to channel their anger and mobilise support.
Oh, that's interesting.
The interesting thing is, I guess there's another perspective. So Marcel Kahn and Ed Rock have written a paper in the US talking about sort of the political economy of corporate governance. And they say often a lot of the debates are around quite minor or peripheral issues, but they are fought so hard because they are kind of a proxy for a broader battle. And I do think some of what we saw here was an attempt to push back at the perceived influence of the superannuation sector. That's my sense. So, and a lot of the contemporaneous media commentary was singling out ACSI and their role in promoting the fifth edition. So, what were the concerns raised through this? Then there were substantive concerns raised. One that came up quite often was a concern that the code had become far too detailed. And related to that was the fact that the code had become far too prescriptive. And the prescriptive concern is an interesting one because the code operates on an if not, why not basis. So how can it be prescriptive? Well, what they said is, if not, why not no longer works. Investors just expect conformity with the recommendations and the guidance. The investors don't want to spend the time thinking about variations. And so the code, which has increased significantly in length, has become a prescriptive instrument. Next, there was the concern about a perceived inappropriate emphasis on diversity and stakeholders at the expense of value creation. And I guess that concern prompted the investor, John Wiley, to come out with his own code, much shorter code, which he said, quote, was intended to promote the national interest of growing the Australian economy. The implication being that the ASX principles weren't doing that. There were various concerns raised about institutional dysfunction at the Corporate Governance Council level. Including that had become captured by interest groups, particularly groups involved in the so-called corporate governance sector. And their suggestion was it's clearly in their interest that corporate governance in Australia becomes an ever-increasing project because they benefit from that. All this played out against the backdrop of I guess, a broader concern about the stagnation of the ASX, concerns about the ASX becoming smaller, concerns about the ASX and the public equity markets having to compete and perhaps being outcompeted by the rise of private capital in Australia. Serious concerns that companies aren't listing because they may find a public listing unattractive, or they might find that there's capital available from private sources that doesn't come with all the complexity and compliance of a public listing. Now, Dimitri Burstein and Peter Swan was at UNSW. They argue that there's some correlation between this alleged decline in the ASX and the rise of the corporate governance principles. And some people might say, well, you might expect, say, Peter to say that. The thing I found interesting was ASIC weighed in pretty categorical terms. So that's from their ASIC issued a discussion paper about the rise of private capital and its implications. They got submissions and then they published a paper summarising where they think they'd got to. And look at what they said to the ASX. We encourage the ASX to promptly, underline that word, turn their attention to refreshing the principles and to consider the benefits of simplifying, again, stress that, future editions, and ensuring they do not unduly deter entities from listing or remaining listing. It was a pretty definitive statement coming from our corporate regulator telling the ASX to sort things out quickly, simplify things, and make sure it promotes a competitive market. I thought that was intriguing.
Do you think because they went along with Bershton and Swan? I mean, it's a global development and phenomenon that the private equity is on the rise and stock exchanges have got fewer companies on them. So, why make it just look like this is only Australia?
Yeah, look, it's hard to know. I mean, it was pretty clear the ASIC was taking a pretty clear stand on the issue, and they were saying things have got to change. And I thought that was notable. And so, I guess I've put that up there because it's not kind of just the usual suspects that were weighing in here. We have our own corporate regulator sending a pretty clear message to the ASX. So what happened in response? So the ASX made some institutional changes. So they have disbanded the Corporate Governance Council. That is gone. The ASX has taken responsibility now for developing, approving and issuing the principles. They've said they're currently now looking to revise them, and once that's done, the principles will be reviewed on a rolling 4-year cycle. Every 4 years. And for the avoidance of doubt, any changes to the principles need to be approved by the ASX board. They will be supported to this in this project by an advisory group on corporate governance. And as I said, they made it clear that the people who are appointed to that have to act in a personal capacity, not representative capacity. And that is because there was a sense that amongst the old Corporate Governance Council, the 19 or so members of that came to the table bringing kind of partisan views. That you had AXI was appointed and they would send someone who would take the AXI line. You'd have someone from the AICD taking the AICD line, and it just became a table surrounded by partisan interests that wasn't working. So they want these individuals, whom I'm about to reveal, to act in their personal capacity. And they go on to elaborate, and they said, by personal capacity, we mean they are going to sit at this table and they are going to think about the interests of the market as a whole. So here they are. So you've got Philip Lowe as the chair. Then you've got the next three are representatives of super funds, including our two biggest super funds, Australian Super and Australian Retirement Trust. Then you have three representatives. I think you could say they're all representatives of the corporate sector.
That's so diverse.
And then Prue Bennett. Now, look, I kind of tried to look at these individuals and read the tea leaves. It's hard. I think you've got three super funds, you've got three corporate, and Philip and Prue, I'm not quite sure where to put them. I think, though, you could probably safely say none of them are kind of the well-known identities in the corporate governance field. We kind of know of some of them, but they are not necessarily, as far as I can tell, none of them were on the Corporate Governance Council. There's a feel there that we've got some newer faces. And so that's the advisory group. So they're the institutional changes. So it's a reasonably big shift in the institutional framework. Then the ASX, through this process, have articulated some objectives for the corporate governance principles, which I think are distinctly different from what we've understood up to this point. So, the fourth edition talked about meeting the reasonable expectations of most investors, but there was also, through the fourth edition and also some of the council's commentary about it, a clear reference to the fact that corporate governance needs to meet or be responsive to community expectations. You now look at what they say, and I've drawn some quotes from various places. This first one echoes a theme that comes up repeatedly, that the principals and the people who are involved in their development have to have regard to the collective interests of listed entities, shareholders, and the market generally. We'll come in a moment to think about what that might mean. Then you'll see again another quote. This is all for the benefit of the market. Then if you look at the charter for this new advisory group, we see references to ensuring the ASX is internationally competitive and facilitates efficient capital raising. The new principles have to be simple, concise, not overly prescriptive, so on and so forth. And then finally, members of the advisory group must act in the interests of the overall listed market. That is, in the best collective interests of issuers, their investors, and investors in the ASX generally.
How many more times could they have put in the market?
And just so you didn't get the message, what I think we see here is an evident strategic commercial focus, a real emphasis on promoting the success of the ASX market. We now have the interests of issuers specifically referenced, quite a lot, and given equal weight to the interests of investors, and no more references to community expectations.
So what's really interesting about this market is after the global financial crisis, I noticed that nobody talked about the market anymore. It was all talking about the public. And so, really interesting that the pendulum has swung back to market speak.
Yeah.
Make the market great again.
Yeah. So that sort of leads us to think about, well, what are sort of the pros and cons here? What do we think about this new approach? Let me start with some risks. I think we clearly have a more explicit commercial mission for the principles. And bear in mind here that the ASX has the ultimate say in their content. So we could see corporate governance playing a much more instrumental role in ensuring the success of the market. Query whether that might lead to a race to the bottom. I don't know. Markets internationally are feeling pressure. Stock exchanges are feeling pressure. That sort of reformulation of the mission that I mentioned in the previous two slides, that sort of mission is opaque and elements of it are in tension. So in terms of the opaqueness of it, it talks about interests of investors. I do wonder whether it's entirely clear what those interests are, particularly in the light of the downfall of the fifth edition. I mean, some investors seem to emphasise E&S issues, others don't. I do wonder whether it's harder these days. I mean, we've been used to thinking about corporate governance in terms of protecting investors' interests, but I do wonder whether it's sufficiently obvious what those interests are these days. Interests of issuers is an interesting one. So what interests does a company have in its corporate governance that is distinct from the interests of its shareholders? And what's the proxy for determining that? Is it the board and management, what they think? Is it the company's interest in having good corporate governance because it will be protective of their reputation or their social license? It's unclear. And then remember, there was the third piece, the interests of the market generally. So what are the interests of the market generally? Because it's being referenced as being distinct from the interests of issuers and investors. So who's left and what are their interests? So I think there's some opaqueness there. I think there's some tension there. Now, I think there's areas where interests of investors and issuers will align. For example, you might say that having a more dynamic market and making it easier for companies could create investment opportunities that are good for investors, for example. But all we need to do is look at the debate around James Hardie last year about whether companies should be able to issue large amount of shares without shareholder approval. We saw a very sharp dividing line between the interests of issuers and who wanted that flexibility and investors who absolutely hated it. So I'm not sure how you thread that needle. I think we run the risk that the ASX and its advisory group, when they come to determine whether a change is appropriate or not, this is a fairly opaque and potentially conflicting benchmark against which to assess something. So, I'm not sure how they plot their path through all this. And then the other danger is they'll decide to do something. We'll have this revised edition come out, and it may not get great buy-in because people have read the mission, but will have varying and quite different interpretations of the relative interests of issuers, investors, and the market generally. Someone will expect something along this dimension, and someone will look at that and expect something on another dimension. I'm not sure that mission statement sort of will provide clarity of direction for the ASX in terms of further developing the principles. Next one is, I think we might have a risk of overshoot. I think the ASX has been feeling the heat both on corporate governance principles and other issues recently. I have a feeling there'll be a strong institutional desire that this process run its course. They update the principles and they're targeting towards the end of this year, and they'll really want them to come out and sort of be considered unremarkable. So I think there is a prospect that we may end up with a very beige revised set of principles as a result. I think my guess is their marching orders will be to sort this out and make sure it's not a big issue. And they certainly would not want to attract the type of criticism that they attracted the other year. The events leading to the demise of the fifth edition, I think, revealed a real disagreement in Australia about what constitutes good corporate governance. So I called that a fractured consensus. Now, if that is a more enduring feature of the Australian landscape, you wonder about the prospects of corporate governance as a self-regulatory exercise. If you sort of read the literature about self-regulatory exercises, it requires that there is a certain amount of buy-in and consensus and so on of the people who are engaging in that. And I'm not sure that exists. And I think the jury's out on whether, if not, why not, works anymore in our current market. I think, half of me thinks, given the nature of the big investors in the market, they're still likely to prefer an approach that doesn't require them to have to think too hard on a case-by-case basis. There's a real advantage to be able to sort of tick the box and say, are they in compliance? Yes, and we prefer not to have to listen to explanations of deviation, because that's all just too much hard work. So there are the risks. I mean, I think there is a potential glass half full story here. It does rely on a bit of optimism and a few things going right. But, this is potentially an opportunity, a bit of a clean slate, and an opportunity for a critical reflection on what constitutes good corporate governance. I think, we could say, yes, there's a fracturing of consensus in the market, but maybe that will provide the circumstances in which there can be greater contestation and innovation in corporate governance. We've kind of had a very... the consensus over the last little while might be regarded as having stifled innovation and debate, and maybe this will open up to a more vigorous debate. And there's the ASX, it was pointed out to them that this new advisory group has really none of the previous organisations that sat on the council. So the accountants, ACSI, the Governance Institute, et cetera, are not on the council. And the ASX said, well, that's okay. They can present their views through public consultation. And I think one possible advantage of that is that the interest groups will have to prosecute their agendas through a public consultation process rather than behind closed doors on the Governance Council. So we might get a bit of transparency about who's saying what, possibly. You might say that those points I've just listed under opportunities do presuppose a degree of optimism and that things go well. I guess I'm slightly cynical. My instinct is the risks will outweigh those opportunities. There is, though, I think, some broader issues and implications that flow from this episode. And I want to sort of kick off this part of the discussion by referring to this quote from Tim Bednall. So I mentioned him earlier. He was the Law Council's representative on the old Governance Council. And he came out after the demise of the fifth edition and he said, "It is not disputed that Australian listed entities need a clear set of governance principles." And I must admit, I stopped on that and went, is it so self-evident that they need it? And I guess what I've been thinking about is some of the things that I've covered in my recent writings about the changes in the market. So you have a think about how our market has changed since the principles first came in nearly a quarter of a century ago. We have significant ownership concentration, particularly in the largest listed entities. We have more activist shareholders, and those activist shareholders now use multiple pressure points to push their agendas. Think of the remuneration vote, no votes on director elections, even shareholder proposals. There are various avenues that the major shareholders can use today to influence the governance of companies. these investors and their proxy advisors now formulate their own governance guidelines. Go and have a look at what ISS publishes for Australia in terms of their policy. Glass Lewis, the same. AXI does prepares a lot of research. Go onto their website, and there's a lot of deep thinking about corporate governance issues. So we're not in some sort of corporate governance vacuum where it's self-evident that we need sort of default rules filling in the gap. The market is reasonably sophisticated. There's been a fair bit of regulatory growth outside of corporate governance, touching on particularly ESG issues. So mandatory climate reporting, modern slavery reporting. Think of the impact of due diligence defences on how companies order their internal affairs, focus on corporate culture. Think of the enforcement environment. I guess the legal settings haven't changed fundamentally over 25 years, but the effect of the enforcement actions, I think, is certainly trickling through the system. And we're about to get imminently the judgment in the Star case, for example, which will have a lot to say potentially on delegation and board responsibility for executive management and so on. My sense is where we find ourselves today is very different from where things were when the code first came into existence. One point that really doesn't come up a lot in any discussion of corporate governance, but I do wonder whether it's quite significant, is our listed market is really a market of two halves. You have the ASX 50, maybe the ASX 100. But then if you look at the data after that, we end up with a lot of very, very small companies. We often have an assumption that our market is homogenous and may therefore have the same wants and needs regarding corporate governance. But the sort of the gulf between the Commonwealth Bank and a small company of $3 million market capitalisation that has some exploration licenses for mining in Western Australia, I think is a vast gulf. And I think there's no set that's kind of bifurcation of the market seems to almost be structural now. So given where we find ourselves today, what is the rationale for having a code? And if you have a look at the literature, there's often a few reasons given as to why you might have a code, i.e. some form of regulatory intervention in a company's internal governance. So the sort of the usual law and economics type view is, well, look, parties should be left to deal with it by themselves unless, some form of regulation can come in over the top and provide helpful default rules that if the parties had the time and inclination, they would have agreed on. And there's a presumption there that these default rules will be material to investors and would have been things that they might have agreed if they'd turned their mind to it. Query, given what I've just said about the market, that query to what extent they need that these days. And certainly if you turn the pages of the governance code, there are some very granular details and you kind of wonder, is that really filling an appropriate gap filling role? There's stuff about onboarding directors, the details of appointment letters, saying that a company should have an investor relations program. I mean, that might have made sense a while ago, but these days, is a code necessary? Is gap filling necessary? Are they issues of such materiality that that regulation should come in and fill that gap? So I think on that basis, there is a bit of a question mark. Now, in the UK, Brian Cheffins and Bobby Reddy have written and pretty much said along that on this basis, pretty much, there's no need for the UK governance code and that it should be abolished. I don't think I'm quite at their point of thinking. I think there is probably some desire on the part of investors in Australia for a code. I think even in the bigger end of the town, and the reason I say that is when I've done research in shareholder activism, there's been a bit of a debate about shareholder proposals, and people have come out and said the law should be amended to make it much easier for shareholder proposals so we don't have to have this double-barreled, resolution to amend the Constitution and then a resolution passing the proposal if the first one gets up. And people have come out and said, look, we'd like law reform to make that a lot easier. Now, the interesting thing is they don't need law reform to do it. It's pretty clear that they could amend a company's constitution to give themselves that right. But the investors always say, no, we don't want to have to go through and give ourselves that right on a case-by-case basis. It is a lot more efficient from our perspective just to have Parliament pass a law. It just makes our life easier. And so I do think, American scholars will often say, private ordering is the most efficient way forward. I get the impression that our investors say, no, to be honest, sometimes we prefer not to have to private order through the market. We would prefer just to have Parliament do that work for us, set clear rules of the game that everyone knows, and then we go off and comply with it. So I think then, to Cheffins and Reddy's the argument, I'm not sure it is as strong in Australia. I think on an economic view of the world, we could say the current code perhaps goes too far, but I don't think we can get to a point on this economic analysis that the code is completely redundant in Australia. And going back to that point I made a moment ago about the market of two halves, I do think there's certainly going to be some parts of the market which would still value a code. So where do I get there on that default rule efficiency justification? I think there is still a basis for a code, but albeit one that's much more modest than what we've got. Of course, that economic justification isn't the only one for intervening here. We have intervention in corporate governance on the basis of fairness, legitimacy, and to address externalities. So, the climate reporting rules, some of the rules around executive remuneration, and some of the mandatory rules around shareholder meetings, I would argue, are examples of intervention driven by these sorts of considerations. But I would query whether the ASX, particularly with this new institutional arrangement, is an appropriate body to be developing corporate governance norms to address fairness and legitimacy and externalities. I think there's a question mark. I think you might accept that kind of intervention is appropriate, but I think there is a question mark over whether the ASX, particularly when you've got this commercial overlay now, is the appropriate body for doing that. And as Cheffins have pointed out, that a corporate governance code is not an ideal mechanism for dealing with these kinds of broader socio-economic considerations, because it's a device that relies on shareholders for its enforcement, and shareholders are potentially imperfect enforcers of more socio-economic issues, just given their incentive structure. And I guess another point you could say is a code that applies on an if not, why not basis the best way to tackle issues of fairness, legitimacy, and externalities? If not, why not, I think kind of makes greater sense when you're working in sort of an agency cost mindset, because you might say, well, look, we'll have this rule. It's designed to mitigate agency costs in general, but if a company thinks it's got alternative arrangements that can manage them, it's an easier perhaps trade-off to make. But if we're saying we're going to have this rule because it's to deal with fairness or legitimacy, why would you then allow a company to opt out? It's either dealing with fairness. So I think there's a real question is if that's the basis on which we're going to deal with develop corporate governance going forward, query whether the ASX, particularly under these new institutional arrangements, is the appropriate body to do that. And then finally, we see governance codes being adopted in a number of jurisdictions, particularly in Southeast Asia, as a sort of a signalling device, or to have a halo effect to signal to the rest of the world that this is a credible market. And so I could imagine the ASX saying, look, we need a code to signal to everyone that we're in the club of good governance jurisdictions. But to that, I'd say, well, if there are matters that the ASX thinks are particularly important to underpin the integrity of the ASX, well, put them in the listing rules. Do they need to go in a code? Further issue, is the ASX the most appropriate body to be involved in this exercise going forward? Perhaps not, but I'm not sure there's an obvious alternative. Anyway, so where I get to on this, and it did surprise me a few weeks ago when I was pulling my thoughts together, is that suddenly I feel like I'm some kind of free market deregulatory, Chicago school type person. It's like, oh, how did I get there? But I do think that, I do think that things have changed. And I get to this position. So I think there's an argument for a code. I think its role should be much simpler than it is at the moment. And I do that not because I'm an advocate for deregulation per se, but I just think the market has changed significantly. I think the big issues in corporate governance have changed from where they were 25 years ago. And given the nature of those issues and the changes in the market, I am generally starting to doubt whether the code should be certainly the all singing, all dancing type of one that we've had up until now. And maybe we say we have a much more trimmed down version that the ASX has. The ASX makes it clear that we're doing this not because we're on some sort of, we're not being dogmatic about a deregulatory agenda, but just because we think the market should have greater scope to fight this out. And then we look to government if there's a need to address bigger issues to do so. Anyway, that's where I've got at the moment. I should have said at the beginning of this that I'm really just pulling my thoughts together here, and what I've just said represents where I'm at the moment. I mean, I do look at all those things I've just talked to you about, and I do find I cannot escape the conclusion that there is a need for a new approach, and it's kind of what I've just said is where I'm currently thinking. But open to suggestions, Steve.
Thanks.
There's one more slide, but go ahead. So I just want to end. This has comparative implications, by the way. So a lot of the literature on codes in the world is about their origins and spread, and I do think the events that we've seen recently in Australia do shed light on the sort of conditions that might lead to a downward trajectory of the code. So I think the Australian story will be very interesting to an international audience because we're perhaps seeing the twilight of the governance code, as it's been conceived of up to this point. And I think this tension, this competitive tension that seems to really be driving, or this competitive fear that seems to be driving the ASX response here, has not just arisen in Australia in isolation. Various scholars have talked about the way the capital markets, public capital markets, are under real pressure across the world. So I think this is probably a change that will continue to play out and will continue to weigh heavily on the ASX as it sort of plots away through all this. And I think, look, I haven't got my thoughts together on this last point, but I think what's happening here will have interesting implications for the ongoing convergence, divergence debate in corporate governance. All right, sorry, Steve.
What else to me? I interrupted your presentation. So that's really interesting. I mean, as I was listening to your presentation before you got to the bit about what to do with the code, I was thinking, and I can see why you have some issues like finalizing your views on this. I was thinking initially, well, the law does a lot of this stuff maybe that we thought wasn't being done when the code was initially, the law may be moving in a direction that covers some of these things, some of these aspects, and which is a more appropriate mechanism, like if not, why not to deal with this, or is the development through legal norms and rules more appropriate, look after climate and stuff like that. And but then I was also thinking, interestingly, part of the development of the law has, as I know it, has been we're moving in this kind of direction, certain recent cases, and sort of saying consider broader, kind of interests, stakeholder interests and stuff like that. And then if I were a director, let's say, and I didn't want that development, and then there was going to be a new code which sort of said, just look at markets. I might be thinking, oh, this is nice, because now I'm getting a really important governance code which is saying to me, just think about the market. So when I'm being told by the courts, or when it's being interpreted by the courts, I can say, well, look at this governance code. I'm just doing what that said. So if you were Ken Henry having that debate at the Royal Commission, you might have been using that, this kind of code. So it's also, I think, important what the code says, rather than should we have it or not. Having it in that form that's being proposed potentially may have negative effects even on our development of the law, or effects on the development of the law.
Yeah, no, that's a good point, because the code has been relied on by the courts.
Yeah.
Yeah.
Yeah, I just wanted to follow on that point about what message does it send directors. I have always felt that there was a real schism between the UK understanding of corporate governance, and let alone corporate governance codes, and the US understanding of corporate governance. And the reason I say that is because the original UK code, the Cadbury Committee, was very much looking at corporate governance as a protective device, so that you didn't have major social disruption because of corporate failure. I don't think the Americans ever saw corporate governance in that way. You have got finance papers throughout the 1990s and beyond, which are all about how do we tinker with boards of directors to ensure that we get superior performance. And so, that is the guiding star for financial economists writing in America. It is, how do we make corporate governance make companies perform better? And so I think you've always had this tension in terms of what does corporate governance mean. You talked about Brian Cheffins and Bobby Reddy, and, it's a while since I read their piece, but part of it, in my recollection, is that they think that the UK Corporate Governance Code had gone too stakeholder, in too much of a stakeholder direction, and that codes weren't really, couldn't really cope with that. I've always felt that it was more like, and I know you like this article, the Eilish Farron paper with Pedro Schilling de Carvalho. So they've got a paper, I don't know if it's out yet, in the Law Quarterly Review, reconciling shareholder primacy and the interests of people and planet. And they're saying, well, you've got this big debate going on between shareholderism and stakeholderism. Who should directors' interests, who should directors be considering when they're exercising their powers? And that paper more or less says, well, England, it's shareholders, we're a capitalist system, but we have other things that put constraints and put societal checks and balances. And that's how I've always seen the ASX corporate governance principles, that these are kind of societal checks and balances on a pure money-making conception of corporations, which of course was really on the nose during the Banking Royal Commission. Outrage that companies were just making money at the expense of customers' interests, etc. So, I think this is a really big issue. Why have a code that just says, yeah, we're shareholder focused? That's kind of what you've got to start with.
Well, and why have a code whose mission now is, I think, quite overtly commercial?
Yeah.
So I accept the point. So I've written down to summarize, I think you've essentially saying don't downplay the normative effect of a code. I think that's kind of how I interpreted yours, Steve, that, it can signal things, and so you talked about it as operating as a check and balance. And I think there's real force in that. But if you have a look at the way the mission's been reinterpreted for the code, query whether it will perform that role.
Oh, I think it's designed not to. It's designed to be full steam ahead American model of corporate governance.
But you almost, if you just got rid of it, then you almost still have the law just operating as the law. But if you replace it with a new thing, then that is making the normative statement that now, despite what's happening in the law, we are coming in as a community and saying this is what we value. Right? So it's really important. I think it's worse. It gives them something to kind of
Duncan, you were.
I had two questions. The first one was about like the super funds voting in favour of the fifth edition. So were they would you characterize them as like the pro woke? And then the fifth.
That's how the media,
voting as well.
That's how the media portrayed it. I'm not sure that's a particularly nuanced. I mean, they were clearly in favour of the fifth edition that included changes that pushed things a bit further in terms of diversity and so on.
Why are they interested in that?
Look, so to be fair, I think the two organisations were represented bodies of the super funds, not the super funds themselves. So you've got the Australian Council of Superannuation Investors that largely represents the industry funds on corporate governance matters, and the Association of Super Funds of Australia, which I think is a broader group that represents the broader interests of the sector. So we can't necessarily infer that the particular funds were speaking in favour. These sort of interest groups were. I think for certainly some of the industry funds, you think of their membership bases. They represent working Australians, and they will have a particular view, I think, about what community expectations are, and what's necessary for sustainable, corporate development in this country. So. There are some commentators in the media who say it's just a political game, and I think there might be some merit to that. But equally, the funds have been saying for many years now this is about risk management, social license, and so on. So it's a long answer of saying I think there's a mixture of reasons why they were for it. Some might be marketing, some might be political posturing, but some will just be an interpretation of what the biggest companies in Australia need to do to maintain their place.
That's interesting.
I would see it more as a conflict. I'd see that conflict less as a kind of a party political one, but more as a tension between capital and management.
Sorry, Brian has asked if he can come on screen and ask a question.
Yeah. So I see that as a tension between the suppliers of capital and management. If you look at, so you've got the super funds, which are significant suppliers of capital, and most of those
they're not just suppliers of capital; they're suppliers of capital with a license from workers.
Yeah, but they're the ones that the managers perhaps are feeling are becoming a little too powerful in the Australian market. So this seemed
globally.
Yeah, and this was a bit of an opportunity for management to push them back a bit. Yeah.
Brian's going to ask a question now.
Yep. So
sorry, Brian.
Is it okay?
Give us one moment.
Right.
Should I mute this one?
Here.
Can you speak now?
Can you speak now, Brian?
Yes. Is that okay? No,
yes.
No reverbish.
No, that's good. That's good.
Okay. Thank you. Thanks for this. Great presentation, Tim. Great discussion. Really enjoying it. And love the references. Would love to see the notes. Can I sort of go to what's going to happen with this new group and what they're going to do with the existing standards beyond the discussion so far? I'll put my cards on the table. I am very concerned that what we will end up with down the track is something that avoids rather than deals with some of those difficult shareholder issues. I totally agree that the corporate governance code shouldn't be used to push certain barrows, but I think there's a need for something that within this kind of standard setting, which still helps in unraveling when is it and how do you take account of stakeholder interests, where it's affecting the value of the enterprise, whether you're a superannuation fund and a company or whatever. So I'm concerned that we'll head away from that in an instrumentalist approach and a shorter code that isn't too different from what we've got, but it'll be shorter and streamlined and stripped back. So what I'd like to try to work out is what the thinking is on what we'll be able to end up with, because they've said, you look at the 4th edition, which is the operative edition. The 4th edition still has lots of stuff in there that goes to ESG and sustainability and DEI, and it's still got a lot of prescription. So it probably did start to overbalance in prescription. And as Rosemary's indicated, there were inconsistencies in the 5th edition between treatment of various things. So that would have been its own problem. But what do? You can have a shorter document like in the UK. You can strip it back to principles and commentary, but that's pretty anodyne for the reasons you've given, Tim. Why do we need that? There's still a need to provide some guidance on the thorny issues, but everyone just keeps on trailing shareholder value and take account of stakeholders where they're relevant to shareholder value, but doesn't really come to grips with what that means. What do we end up with? I'm trying to work out what is a meaningful way forward. You can't go too far from what's in the 4th edition because people have got used to that. So taking anything out becomes problematic unless everyone agrees. Just take out all the prescriptive stuff and all of the suggestions for how you might go about doing DEI and whatever. You could do that. I'm just sort of interested in where this actually goes.
Yeah, thanks, Brian. We've just got to mute you because we've got an echo loop while I respond.
Okay.
So I agree with how you've read the tea leaves. I feel it's going to end up as a pretty anodyne document. And then that's what got me. You might remember I had a slide, it flashed up briefly and I dismissed it. It did get me thinking about, as you say, there are some thorny issues that we still need to work through in this area. And just pretending they're not there is unhelpful. And maybe we need to think about some other body to address those, particularly if the ASX goes down this sort of more commercial focus. Now, I thought of that and went, oh, there's no obvious alternative. And you would have seen that slide. It was a very brief slide. It's a point, though, I think I will need to think about in more detail because, as you say, there are issues that need to be worked through. I guess the reservation I had is particularly Cheffins and Reddy are very dismissive of the institution that issues the UK code, which is a quasi-governmental one, and they say is incredibly bureaucratic and out of touch. And I guess I'd read their article recently and that might have been weighing on me. But maybe we need to look elsewhere, I guess, is what I'm saying, for the sort of guidance that you're saying the country and the market still needs.
So just a quick follow-up to that.
Steve's just volunteered.
Sorry, hang on, Brian. All right.
Brian wants to come back. Yep.
Sorry, without dominating the airways, if I could just make a quick follow-up to suggest something. I know from discussions, without going into sort of confidential stuff, but some people on this call would have been part of the Law Council Australia Business Law section discussion of this stuff. And I know the issue was raised about whether or not some of the commentary and guidelines and principles and examples sort of stuff should be relocated from the code to another forum. So I'm not trying to put any work in front of anybody, but I think there is a leadership opportunity here for somebody working with the new group to say, look, if you're going to strip it back, and you probably are, and you probably need to, but relocate the battles or relocate the need for guidance to something else. We'll work with you. Somebody could come up with something, probably a consortium of business law section led by an academic group and with other representation that takes out the stuff from the current 4th edition that really shouldn't be there, and which we could get agreement on really is too prescriptive and just too much. And it can be relocated to sort of some kind of pathfinder that's developed. You could probably even get a grant to do it. It would be a very worthwhile contribution to help everybody in this ecosystem and to have a much more simple, streamlined code for all of the reasons that we probably still need a code that you've articulated, Tim. But relocate the rest elsewhere, and then it can be a source of ongoing guidance. And I'll stop there.
I think you can just use my laptop if you want. Like the speaker should pick you up fine.
Brian, can you hear me through the laptop? Yeah, that's a really interesting suggestion, and I get the sense, just speaking to people as well, that there is some appetite for a contribution in this field that doesn't come from the corporate governance industry. So, yeah. So
my class suggestion wasn't such a joke.
No, I don't think it is. I don't think it's, yeah, I think there would be a desire for that. Yeah, that's a good point.
The project we're doing with the UK people.
Yeah. So, CLARS got a joint grant with Warwick University to look at, I guess, how the UK code and the Australian code have tracked, and the sort of the intuition is they've maybe diverged, and I think certainly they're diverging based on what's happening here. And that's a project that's about to start imminently, and I think that will be a really interesting one. And I was telling someone about it the other day, and they said, wow, that's really interesting. I'm sure Philip Lowe would love to hear about that. And so Brian, I do, based on that conversation, I do agree with you. I think there is an appetite for the kind of contribution we can make as academics in this area.
Well,
You're good.
and we're going to wrap up at this point. If I could just thank everybody that came along and ate delicious bagels with us in this room.
And thank you for the bagels.
And also everyone who joined us online. It's been a fantastic presentation, Tim, and lots to talk about. And, it kind of seems a narrow issue, but it's not at all. It's a really broad global issue of where corporate governance principles are going. So thank you again, and we'll just thank Tim.